Let's talk about why we would demand foreign currency. All right, so we're here in Canada and we use Canadian dollars. So why would we ever demand a foreign currency? So for example, why would you ever need US dollars? Well, one possible reason for needing US dollars is because you want to go visit the US. In which case, you're going to need to take your Canadian dollars, convert them to US dollars so that when you cross the border, you can buy souvenirs and go out to dinner. So tourism is one of the reasons that we demand foreign currency. The second reason we demand foreign currency is for trade, right? We have exports and we have imports, right? So what are exports? Exports are where we make goods and sell to people in other countries. Well, if we're going to sell our goods to people in other countries are going to need to convert their money into ours to buy our stuff. Okay? So there, other countries are demanding our currency. Imports is where we buy goods made in other countries. So we're bringing them in. In which case, essentially what we need to do is we need to convert our money to another country's money in order to buy their goods, okay, to import them in. So trade, exports, and imports are going to impact the demand for foreign currency. So while we're talking about trade, let's take a look at what's happening with trade in Canada. So our four largest trading partners, if we look first at exports, you'll see that our primary trading partner in terms of who buys most of our Canadian goods are the US. After that, China, Mexico, Germany, and Japan. Who do we buy most of our goods from? Who do we import most from? Well, we import most of our goods from the US. And after that, China, the United Kingdom, Japan, and Mexico. So we do a lot of exchanging Canadian dollars for US dollars because we buy a lot of their goods and they buy a lot of ours. When we look at those goods that we buy and sell, we can look at our top exports and imports. So when it comes to the goods we bring into the country, the top good that we bring into the country is automotive products. So there's car parts and there's cars themselves that are made in the US that we bring into Canada. Now notice that when it comes to exports, the primary thing that we sell to other countries, particularly the US, is also automotive products. So in fact, when it comes to cars, we specialize in making of some vehicles. The US specializes in making other vehicles, and then we trade. So rather than both the US and Canada making the Toyota Camry, one country makes Toyota Camry and another one will make the RAV4. And then we drive it across the border. So you notice that we import and export a lot of the same goods, metal products, consumer goods, because we specialize and we trade. When we look at that trade, we can look at our balance of trade. So in 2017, the US President Donald Trump has made a lot of comments about how the US is being hurt by their trade agreements. They're being hurt by the trade agreements, he says, because the US has a trade deficit and the other countries have a trade surplus. So if there's a trade deficit, then that means you're importing more than you're exporting, and money is leaving your country. If you have a trade surplus, then you're exporting more than you're importing, and money's coming into your country. When we look at this chart here, we see our trading partners with Canadian trading partners, and we can see who we have a trade surplus with and who we have a trade deficit. So depending on what we buy and what we sell, we may have a trade deficit with one country and a trade surplus with another. So notice we have a trade deficit with China. That's because we import a lot of their goods into Canada, we don't sell them a whole lot of ours. On the other hand, when it comes to the US, we sell a lot of goods to them, more than they buy from us. And so you may have a trade deficit with some and a trade surplus with others. So let's talk about why do we trade? Okay, what are the benefits and the downsides to trading? Well, the benefit to trading is that we can consume more than our country can produce. And we can consume goods that our country would not be able to produce otherwise. So in Canada, we don't have the ability to grow our own coffee beans or pineapples or citrus fruit. So we buy those from other countries. We also are able to specialize and make some things more efficiently than other countries, and then trade those for goods that other countries can make more efficiently. So we can consume more than we could produce on our own. We also get access to a bigger variety of goods, right? The pineapples and the oranges that we couldn't make on our own. And when you open up to trade, there is more competition. So now that you have to compete on a global market instead of just on a domestic market, it creates incentive for the quality to increase. So for example, if we look at automobile manufacturing in the 80s, when we start to see an influx of Japanese vehicles coming into North America, well, Ford and GM now have to compete against Toyota. And Toyota, at the time, was the leader in quality. So if there is this new competitor that's much better quality than you, then that means that you have to step up and improve your quality as well. So the more trade, the more global competition, the more the quality improves. That increased competition also drives down prices. If you want to be the one to win the customers over, then you got to have the one with the lower price. Now, it also has an impact on income. We often hear arguments against trade like that we're creating sweatshops in Asia, and it's creating environments that are inhospitable for employees to work. We're having slave labor is created by globalization and trade. Well, in fact, trade actually creates higher income. So if you think about it this way, if your country has very little trade with the outside world, then the workers, there may not be a lot of jobs for them within your own country. And so the unemployment rate is high and wages then are low. But the more your country trades with other countries, the more demand for your country's goods, which means the businesses within your country expand and they need to hire more workers. So now there's more competition for workers. All these businesses that are producing within your country to sell to the rest of the world, they all need workers. And how do you convince workers to work for you? Well, if there's lots of competition for workers, workers are going to choose to work in the place that has better wages, better working conditions. And so the more global trade, we actually see that overall wages increase, working conditions increase, and the idea of sweatshops, they go away. Okay? So what are some downsides? Why might we not want trade? Well, there are 4 general arguments for not having trade. The first is the strategic industry argument. And this argument says we need to reduce our dependency on other countries. So there are strategic industries, industries that are just so important that we need to make those goods domestically. We can't have us buying those things from other countries. So we can't become too dependent on other countries. So think about this. Military, right? We don't want to completely outsource our military to other countries because what if World War III erupts and all the countries that were providing our military work we're now at war with? oil production, right? We need to produce that domestically because if World War III breaks out, we need to make sure that we still have enough gas that we're refining so that our country can keep operating, even if the countries we would have bought our oil from are no longer selling to us. Or wheat and some farming. They become strategic industries as well because we want to make sure that our people have enough food, and the way to do that is to protect the industries that are vital to our country. So we strategically choose industries that are necessities or vital to our country. The second argument against trade is the infant industry argument. And the idea here is we're going to protect new and vulnerable industries. The idea is to shelter these companies that are just getting started from that global competition, because there's no way they can compete right off the bat with those low-cost producers around the world. So we shelter them from that foreign competition until they get up on their feet and get up and running. So that's the infant industry argument. The third is what we call cultural identity argument. This is where we attempt to protect our national identity. So this is where there's content laws, for example, in primetime television on a Canadian channel, it has to be Canadian shows. On the radio, it's got to have a certain percentage of Canadian artist content. So this is to make sure that we maintain our national identity. That is, in Canada, that we don't become too Americanized and that we remember who we are as a country. So we make sure that we maintain movies, TV shows, music that is Canadian-made, Canadian artists. We also have restrictions on foreign ownership of newspapers and educational institutions, and the idea is to maintain that cultural integrity, to be true to who we are as Canada when it comes to our news and our institutions of learning. The fourth argument against trade, it has to do with environmental and labor standards. Right? So other countries may not have the same environmental regulations or labor regulations that our country does. So there's arguments for and there's arguments against trade. In economics, the benefits outweigh the costs. Almost all economists will argue for globalization and trade, which is in stark contrast to the US President Trump, who is actually taking a more nationalistic approach and wants to change the amount of trade, right? He wants it to be more favorable to the US, and that's why discussions in 2017 about renegotiating NAFTA, so that's trade with Canada, so that the US can have more of a trade surplus rather than a trade deficit, and reduce some of the trade. And what they're looking at here is the protection of jobs, so increasing the amount of strategic industries to create more job opportunities for them. However, when we look from an economic standpoint, most economists are in favor of globalization and trade because what it does is it raises living standards for all countries and it increases the total amount of goods for all countries. So collectively, you're better off. All right, so let's go back to our list. Which is a little bit blurry at the moment. But we said that we demand foreign currency because of tourism. We travel to the US. Because of trade, and we looked in detail at trade. And then the last two are financial investment and speculation. So when we talk about financial investment, we're talking about buying stocks and bonds. So when you live in Canada and you buy mutual funds, included in those mutual funds are stocks in foreign countries. Okay, so your mutual fund that you buy might have stocks of Apple in it. Well, Apple is an American product, and so essentially what we're doing is we buy those mutual funds, then those stocks are being bought on your behalf, which means Canadian dollars have to be converted into American dollars to buy those stocks. So countries invest in each other. When you buy bonds as an investment, and it is bonds from other countries, you're buying other countries' debt. So we can look here, for example, and see foreign investment. So you can see how much countries invest in each other. So we said that we demand currency for tourism, for trade, for financial investment, and then the last one was for speculation. So what do we mean by speculation? Well, speculation is where you attempt to buy low and sell high. You're trying to profit from the variability of currency. So just like you do financial investments where you buy a stock hoping that it will increase in value over time and then you'll sell it, the same thing can be done in terms of currency. So when the Canadian dollar is low, that is, it's not worth a whole lot of US dollars. So let's say we go back to the mid-90s, one Canadian dollar was like 60 cents US, super low. So at that time, you could buy a bunch of Canadian dollars, if you were an American, for example, and then we wait until, what was it, just a couple of years ago, around, what was it, 2010 or so, 2015, where the Canadian dollar got really close to par. So one Canadian dollar was really close to one US dollar. If you were doing speculation, then you could sell your Canadian money back into US dollars and you would have made a bunch of US money. So speculation is where you profit from the variability of currency. You predict that the currency is going to go up or down, and then if you buy it low and you sell it high. So we demand foreign currency for tourism, for trade, for financial investment, and for speculation.